We are live, Vivek. Hello, everyone. My name is Ankit Kejriwal. Hello, everyone. My name is Ankit Kejriwal. My name is Ankit Kejriwal. There was slight echo. I hope it should be fine now. Okay, let's restart. Hello, everyone. My name is Ankit Kejriwal. I welcome you all to Gulaq's AMA webinar. Today, I have with me Vivek Sharma, who is the head of investments at ST Advisors and Gulaq. He'll be taking you through the rebalance update for the month of January. Uh, what changes did we did this particular month compared to last month? And we would also be breaking down returns that the portfolio produced during the last month. And lastly, we would be taking some question and answers that we have already received from you guys and also some live Q&A. So a little bit about ST for those who have not been initiated. ST Advisors is the uh, over 15-year-old firm. It's a pioneer in systematic investment in India. It was founded in 2008 when SEBI just allowed algorithmic trading in India. And over this past 15 years, we have been working with some of the leading financial institutions uh, in India and across the globe, and we have been helping them with building investment products using advanced quantitative analytics and computer science. We operate in 6 countries and have received numerous awards from the exchange. Gulaq is the retail investment advisory arm of ST. It uses the same research as we do with ST, which is a parent company. But this is a retail investment advisory arm. So we repackage the same research into creating portfolios, which is friendly and more consumable towards retail audience. We launched this in 2020. We are a SEBI registered research analyst, and so far we have successfully served over 27,000 subscribers. A little bit about our founding team. Mr. Sandeep Tyagi is the CEO and founder of ST Advisors and Gulaq. He holds BTech from IIT Delhi and also holds an MBA from Columbia Business School. Cumulatively, he has over 3 decades of experience in the industry. And we have with us today Vivek Sharma, who's the head of investments at Gulaq. He has done his BTech and MTech from IIT Kharagpur, and he holds over 2 decades of experience in trading and investment management. And before we start, just a disclaimer that this webinar is purely for educational purposes, and nothing in this webinar is an investment advice. You can all read all the relevant information like our SIN number, our registration number on the screen. Over to you, Vivek.
Okay, thank you, Ankit. Thank you. So, just because a few of the investors who have joined us have been associated with us for the first time, for their clarification, I just want to uh, take them through our gear-based methodology. So, our gear-based methodology is based on different risk levels. Like investors, every investor has its own risk profile, his own risk appetite, his risk need. And also, this is dependent on the life stage they are in. They might want to be very aggressive with their investments or want to be conservative with their investments. And hence, we have launched these multiple gears. Gear 6 is 100% equity, Gear 5 is 80% equity, 20% debt, and so on and so forth, all the way to Gear 3, which is 40% equity and 60% debt. So gear 5 and 6 are for aggressive investors. For moderate investors, it could be gear 4 and 5. And for conservative investors, we have gear 3, which is 40% equity. But the important point here to note is that in all of these, the equity component remains the same. It has the same stocks, only the allocation to equity differs. That's the only difference here. Next, differences between past month and this month. Large cap allocation has slightly gone up from 13 to 16, and mid cap also has gone up from 45 to 52, and we have seen some decent reduction in small cap allocation from 42 to 33%. This is the change across sectors. So if you look at this, the biggest change has been in consumer staples, energy and healthcare, where our allocations have gone down, uh, and materials and utilities are the two sectors where our weightages have gone up substantially. And these two sectors now constitute almost 50% of our portfolio in February. Now, this shows us how we are allocating weights to these factors. So this has been for the past couple of months same. Value has the highest weightage, about 76%, similar to what we had in January, and also quality, whereas momentum, volatility, and leverage have 0% exposure. This shows the performance over multiple time frames. So over the short run, yes, we are struggling here. Our portfolios are underperforming, and but over long run, we have delivered pretty substantial alpha here in Gear 6. Now, because the equity component is same, you would see similar kind of performance in other gears also, that in the short run, because our equity portfolio is underperforming, that's why we see underperformance in the short run. But over long run, 3+ years, we have delivered a pretty decent alpha. This is for Gear 4 and this is for Gear 3. Gear 3, because we have 60% debt, and that's why you see the extent of underperformance is also lower, and over 1 year time frame we are slightly positive. This is primarily because the debt component, which is more than equity component in Gear 3, 60% debt is there. So this is the overall summary since inception and across multiple time frames for multiple gear-based portfolios. Gear 4 has only a 3 year track record because we launched it much later in September 22, whereas others we launched in May 2020. Okay. Now taking you through these large, mid, and small cap portfolios. Now these are primarily for experienced investors who want to take exposure to one of these three market cap based portfolios. Again, for new investors or for those investors who really don't want to get into large, mid, or small, the gear based methodology works fine for most of the investors. This is really for some experienced investors who want to take specific exposure in these three. We launched it in December 2024. We have seen some bit of turnaround in our performance over short run. Over long run, since inception, this has uh, large cap has had some bit of underperformance. Similarly, in mid cap also, we are seeing uh, underperformance since we launched about 2 years back or so, about 1.5 years back. Small cap is the one where we have seen the turnaround now. It was also underperforming since some time back, but uh, now we have seen the turnaround in small cap, and this is now showing in all three time frames, 1 month, 3 month, and since inception, this is showing some bit of profit. Obviously, this is quite different than the back tested results, and the performance over short run definitely can vary a lot uh, as compared to the average results of the backtested performance. Yeah. We have also been publishing YouTube long form YouTube videos. You should definitely uh, check out our videos. These are some of the videos that we have published over past couple of weeks. One is on mutual fund investing, what works, what doesn't work. This is based on uh, the data on our app. Thousands of investors are using this specific Gulaq app to analyze their mutual fund portfolios. It gives you a very nice analytics x-ray of your current portfolio across sectors, across market caps, which funds are performing, which funds are not, how funds are correlated, what kind of fees you are paying. So it's a nice app for you to really assess how your overall mutual fund portfolio is doing. And in next couple of months, we'll be rolling out advisory for mutual fund portfolios as well. So this is one video. Another video is around SIP versus lump sum. What works, what doesn't work over long run, and this is all based on historical data. So these are nice videos. We have put in some effort in this. So please, if you are interested in learning about markets, about investing, please do check out our YouTube channel. Okay, so that's about the data. Now, I'll be taking questions. No, some of the questions that we have received, I'll read them out and then I'll be taking them. And please feel free to put in more questions if you have any specific questions in specific about our portfolios or in general about investing. Please do put it down, and we'll be happy to take those questions also. So, yeah. So I think some of the questions have been around portfolios that in last 1, 2 years, the portfolios have been negative, and when can the performance improve? And also what exactly we are doing about it, what corrective steps are being taken to improve the performance. So see, these corrective steps, frankly, we are not only taking it right now because our performance is in the short run hasn't been that great, but our research team who works on these portfolios, the methodology is always working on improving the methodology. So this is always a constant process. Obviously, now it makes much more sense to maybe look at it much more closely. And now that year has ended, we do a full deep dive on the yearly performance as well. So this is something that we have been working very closely for the past couple of months, and hopefully we're still not ready with the new portfolios, but we have made significant progress. But we definitely would want to launch something concrete when we are sure about it. So it might take couple of months more, but we have made significant progress in the way we construct our portfolios. And one of the changes that we see is it really helps us if we, as of now, we have pretty good weightages to fundamental factors as well and also technical factors, but we came up with few more technical factors, and if we increase the weightage of these technical factors, it seems to be giving us much more stable performance, uh, similar kind of performance with lower volatility. Obviously, we are yet to finalize it, but we are in the past. Maybe we'll be able to finalize it in next 1 to 2 months time. So that is something that we are working very hard on for the last past couple of months, and we'll be launching these upgraded portfolios sometime soon. That is one thing. Uh, when can this performance improve? Frankly, I don't have an answer to that. Uh, but we can look at the historical data. Our historical data, what it suggests is the worst case performance if we compare to all the historical backtests that we have seen, we're very close to that kind of worst case performance over a 2 year time frame. So if our live track record follows those historical backtests, then we are very close to the turnaround. That is one thing. And another thing is also because most of these momentum strategies, the alpha comes, most of these quant strategies, the alpha actually comes, the outperformance primarily factor is momentum, which is the biggest contributor of alpha. So now that we have seen markets also turn around, the closing, they made all-time high also some time back. So if this momentum were to continue in the broader market, I would strongly expect that our strategies also start performing well because of the underlying momentum in the overall market. And whenever our strategies do perform well, the extent of alpha is relatively huge in the sense that when we are underperforming, our underperformance is primarily in single digits for the year, but when we are outperforming, our outperformance is in higher double digits, something like 15, 20, 25% of that order. At least that's what the historical data tells us, and that would be my expectation looking at the historical data, that if the turnaround happens, I would expect very strong double-digit outperformance in our portfolios. So that is my expectation. Again, timing-wise, it's very, very hard to say really uh, when that turnaround would happen. But whenever that does happen, my expectation would be a very strong turnaround, and we would be able to deliver that kind of outperformance as we have seen in the past. So that's what the expectation is. Okay. Then the other set of questions is around, okay, one set of questions is which stocks or strategies can deliver high returns, and which sectors, which themes should investors look at in 2026? Now, my honest answer to this would be I don't know, because the way we work, we construct these portfolios to identify what is working, what is not working in the market, and and then give weightages to what is working, and reduce weightages to what is not working. That's the broader methodology that we don't try to predict in our portfolio construction approach. We are not trying to predict what is going to work, what is not going to work. Rather, we are trying to adapt. If something is working, the algorithm should be giving more and more weightage to it. And if something is not working, we keep reducing our portfolios. Obviously, we have seen the times like past couple of quarters where this strategy really did not work as expected, but over long run, we have using the similar kind of methodology, we have given pretty good returns. So here the whole idea is not about uh, actively predicting what's going to happen, but rather adapting to what is happening. And that gives us, I think that's what our advantage is, that's what our skill set is, and we don't want to stray away from what we know best. So that's why we were not going to predict. So you're not going to get any answer from me regarding what which specific stock or sector is going to work. But overall, the methodology should help us identify that specific stock sector, and hopefully we'll be present in that so as to deliver alpha. Yeah. Okay. One other question is also around outlook for Indian markets. So I've told you about our outlook for Gulaq portfolios. Very hard to say in short run. Similar is the outlook for Indian markets. I think couple of things that are working well for us, what we are seeing in the news, US, Indo-US trade deal, even with European Union, we have a trade deal. So this is giving good momentum to Indian stocks. Another thing is also the relative valuation of Indian stocks, which is at a much better stage as compared to past few quarters. In the September 2024, when we made the high, I think the overall valuations were pretty high. And now those valuations have cooled down. In fact, that was our expectation also I remember in 2024, because of the way markets had given huge returns in past few years since the COVID lows. We were always saying that if you keep expecting these kind of returns overall from the markets, you will be disappointed, because there's no way markets can continue delivering those 25-30% kind of returns annualized over long period. So market returns comes in very short bursts, and then they go sideways and or have negative returns also. So that was the overall expectation going into 2024, and we saw that towards the end of 2024 when markets made a high. So the point being that now I think the valuations have cooled down, definitely so in large caps, and to a decent extent in mid and small caps also. I don't think mid and small caps are cheap, but they're not as expensive, and definitely there are some pockets where we feel the opportunity is there in mid and small cap as well. Uh, Talking about Indian markets, Indian economy in general, overall, uh, I don't see any reason. See, a couple of years back, everyone was so bullish about Indian markets, and I don't see a reason why why we should not be bullish about Indian markets over next 5 to 10 years. Obviously, in between, there are going to be years like what we have seen where markets haven't produced any returns or negative returns. But over 10 years, I personally am very bullish on Indian economy. We are going to see huge returns from stock markets. And even last 10 years also, the kind of returns where we have seen 12, 13%, there is no reason why we should not be able to deliver the similar or better performance over next 10 years. But it's not going to be easy. In order to make those kind of returns, frankly, you have to stay invested through good and bad times. Only then one would be able to reap. If we try to time the market, that almost never works. It works against investors, and investors typically lose out in trying to time the market. So my suggestion would be stay invested for long run, and if one can ride out the volatility that we are seeing currently, only those investors would be able to make good returns over long run. So yeah, that's what. Ankit, please feel free to add if you want to add anything.
Yeah, Vivek, I completely agree. In fact, based on what you were saying, I remember the story of Magellan Fund of uh, Peter Lynch. I mean, it was one of the best performing mutual funds of all time, delivering like I think 29-30% return over a period of 13 years. And we
Yeah.
saw that despite it being the best performing mutual funds, on average, an investor lost money in that particular fund because most of the investors entered that particular fund when it was performing well and then exited when it was subsequently not performing well. So they entered high and then exited low. And I think that applies universally to a lot of funds, including us. We were performing quite well, but recently we have not been performing well, and as a result, we have seen a lot of investors exit our portfolios as well.
Yeah, I think good point. We're not saying that we will, there's no certainty obviously in active investment, but I think great point that we have seen similar kind of thing happen in the past also, and we are seeing it this time also, that a lot of investors came in towards the end of 2024, where at the time markets were also at all-time high and we had huge alpha. A lot of investors came in at that point of time, and obviously we had a lot of investors who had stayed invested with us since COVID times. But yeah, obviously a lot of investors come in when they see huge returns, and now they're I think frankly the people who have joined us in last 1.5 years are disappointed. Yeah, I see that. I keep talking to them. I see a lot of investors are disappointed, but many of them, even though they are seeing negative returns, they understand that they are in for the long run, and many are putting in new money, whether lump sum or SIP. So many are doing that as well. And some of the investors obviously have lost patience and going out, but many are continuing. And hopefully we'll be able to live up to those expectations. Our money, frankly, my money, this team's money is invested in our strategies. So we do have skin in the game. Yeah.
And I think a lot of investors tend to compare the performance of the fund that they have invested in, like ourselves, with the top performing funds within currently. So right now, I think defense sector has performed very well. So they'll compare our performance with the
Yeah.
defense sector, not realizing that I mean, the defense sector, that particular fund itself would eventually go through cycles of underperformance and outperformance. So it's not always a fair comparison of comparing your particular fund with the best performing in the recent category. In fact, we were just discussing that you had done some research and found out that mean reversion really kicks in. And if you keep investing in the funds that have really good performance in the last 1 to 3 years, then overall your performance would not be exceptionally great. So it's important to stay invested and stay throughout the cycles of ebbs and flows of the market.
Yeah, I think good point about mean reversion also. I remember reading about this fund uh, in US. So this specific fund that I'm talking about, it never came in the top 25 percentile of the universe. It was always in the second quartile, which is from 26 to 50 percentile. But it was never in the bottom 50% also. It was in that second quarter always for about 20 plus years, right? Not even a single year it was in top 25 percentile. But what this consistent second quartile performance delivered over 20 years is, if you look at the overall 20-year performance, this specific fund came in the top 5%, which was pretty surprising because it never came in top 25 percentile for any of those specific 20 years. And the reason was exactly that you mentioned about defense funds, that the top performing funds in short term most likely are there because they are taking huge risk, and they can continue delivering for short period of time, but ultimately those risks play out and they will also be most likely in the bottom 25% also. So that's what happens a lot. So there is definitely a lot of value in consistently delivering that performance. Okay. There was one more question related to the net versus gross returns. So there, what investors can do is, I'll quickly share my screen. So on small case, there is this feature which I I like, and I don't think many of the investors had a look. Ankit, can you see my screen?
Yes.
Yeah. So on small case, you have this specific feature where you can uh, look at the overall investments. It does show you if somebody has invested, say, 1 lakh over multiple time frames. What's the cost? So the cost would be the subscription fees for 3 years plus the transaction charges. So overall, the money put in is about 1.28 lakhs. And then what's the small case value? 1.84 lakhs. And what's the overall net profits delivered on this investment? And the investment is includes your costs as well. So this you can have a look at multiple time frames, and by the way, it is related to it is connected to your broker. So if you're logged in using say HDFC, it will show you the transaction charges for HDFC or Zerodha or Dhan. So for me, because I've logged in into this account using Dhan, uh, for me it is showing these are the transaction charges paid to Dhan, right? So you can use this specific feature where you can edit your amount, your brokerage type, your brokerage fees, and what's the rebalancing date. Obviously, a lot depends on if you are rebalancing on time or not. But this is a cool feature which you can actually see to understand how much cost you're paying. One of the costs that is not really included in this is also slippages, because when you buy and sell, when you rebalance, there is some small slippage also that you are paying, and that is very hard to determine because it depends a lot. It differs a lot for each and every investor. What time of day, what day, and with what quantity they are rebalancing. So it's very hard to determine that, but this is the cost which everyone which can be determined to certain extent, and they have included these costs here. So this is out there in small case. You can have a look cost adjusted returns over multiple time frames, and you can edit and see how the specific portfolio have done after costs. Yeah. So I think those were the broad questions that we received. But Ankit, if we have any more questions, I'm happy to take those also.
One point that I wanted to touch, Vivek, recently the budget was announced, and in the budget we saw that STD was increased, and I know that the trader in you would have hated that increase in STD, and the market's reaction towards that STD was very weird. Initially, the market fell, and then the subsequent day it rose again. So, what are your views on that?
Frankly, I didn't hate it because I loved the STT increase, frankly, because I personally know a lot of investors who are burning money uh, in FNO trading, right? In fact, just couple of days back, I was talking to a trader. He was very optimistic about the money he is going to make in the near future in FNO. When I asked him how his performance has been, he said that last year he lost about 25 lakh rupees in FNO, but in the past 2 months he hasn't lost any money, and that's why he was optimistic that he feels he has figured out the formula to make money now, and he was very optimistic that he'll be able to make everything back in the next 1 year and more. And there are lots of stories, lots of traders I talk to. So I definitely feel it's right step if it is able to curb the FNO trading. It can really help a lot of traders avoid those losses. So I am optimistic there. Uh, it's very hard to really, for someone who has been trading, losing money, to stop trading. It becomes kind of addiction. So I hope this is able to help them stop trading. So that is one thing. Second is about the daily volatility. Ankit, frankly, I don't read too much into this because I personally am not concerned about day-to-day movements. I am more more so look at markets over long run, because these kind of volatility happens whenever these big events. When the elections were there, couple of years back, even then you saw this kind of volatility. Initially, market going down, then up. So it was quite a volatile couple of days even during that time. Uh, if someone has money, market's correct, then maybe it's good time to invest. But frankly, I don't read too much into this. These kind of things don't matter really so much for long-term investors. So that's what I have to say. But if you have a point, please do feel free to share. If you observed something specific in this budget, which you want to share with everyone.
A lot of investors were expressing the concern that foreign institutional investors were already heavily exiting India, and the FII outflows were already very heavy. Now, with the STT increasing, the amount of money that they used to hold in equity and pledge it to trade in the FNO market, a lot of people were speculating that that money would also start exiting India. So, do you think that it is a long-term concern for India,
No,
Indian stock market?
frankly, this specific reason I don't think, because most of the long-term investors, FIIs, who come and invest don't really pledge that and trade. In fact, they are not allowed. They're not allowed to pledge. Only Indians are allowed to pledge their holdings, those stocks, and trade. FIIs can't really pledge mutual funds or stocks. They can pledge GSECs. So they invest in GSECs. So all those, there are two kinds. Then there are two kinds of FIIs. One is long-term investors who just buy and hold. For them it really won't matter so much. For the other kind of FIAs who are primarily in Indian markets for FNO trading, to them it will impact, but they don't necessarily buy stocks and pledge. It's not allowed. What they do is they buy G6, then pledge that. So G6 may whatever they are making out of those G6 interest rate, it covers their rupee depreciation, roughly 3, 4, 5% of that order, right? And then they pledge it and use that for FNO trading. So those kind of traders primarily, trading institutions would get impacted. Like anyone in India who is getting impacted, who is trading a lot, would get impacted. But not the long-term investors, not the long-term FIIs who are here for long-term. So yeah, I personally don't think that's the reason. But yeah, the FII traders would get impacted. Like lot of prop trading firms who trade FNO in India, they would also get impacted recently.
That includes us.
Yeah, that includes us. We have a prop trading arm which is going to be impacted to some extent, yes.
Okay, I have a few questions from investors, but they are again regarding performance. I think we have already touched that. Do you want to touch on it again?
No, I think the whole point I'm trying to make is we are aware, we acknowledge what the recent underperformance, and the message is very clear that we are working very hard to really upgrade, to fill in the gaps that we have now observed in our portfolios, in our methodology over last few quarters. And hopefully in the next couple of months we will be rolling out something much more improved from what we have learned in the past couple of months. So that research, I don't really want to comment too much on it because that research is still undergoing, but definitely in the 1 or 2 next few months you're going to hear about that from us.
Okay, Vivek, I don't see any more questions. Do you want to wrap it up?
Okay, yeah, that's it from our side then.
Okay, thank you so much, everybody, for joining in. This webinar is going to be available on Gulaq's YouTube channel. So, in case you want to revisit any section, you can always do that. Thanks, Vivek.
Thank you, Ankit. Thank you, everyone. Thanks. Bye.